Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah and it's a special show because the Mutual Fund Show, your Mutual Fund Show, is turning 2 years old, so to say. It's been 2 years that we started this show, and almost every single week, for me at least, has been a week of learning, and I hope for you as well. It turns out to be a show wherein you go back with something that you didn't know about mutual funds. But it's a special day, and we have a special guest, Balasubramanian. He's the Chief Executive Officer at Aditya Birla Sun Life. Bala, so good having you. Thank you so much for joining us today on the Mutual Fund Show.
Yeah, thank you, Neeraj. It is my pleasure to be part of this event.
Thank you, thank you. So we thought that if this is indeed turning out to be a show wherein we're celebrating 2 years of the show, what is it that we do which is slightly different? And typically on every show these days, we talk about that one big question. We thought let's expand that list to 4 or 5 key questions that must be on the minds of investors right now.
Correct.
And try and address them and try and speak about what would the expert opinion be. So that's the tack that we're following for the show today, Bala.
And I'll be happy to take those questions and try and do my best possible that I can please the audience.
Well, okay, yeah. Well, let's just try and speak about what the factual data suggests. We've got some of your responses as well, but let's start off with that, Bala. And I think the first and the most important question, ever since the last month and a half, wherein a couple of those reports came out about how the wave 1 of the liquidity crunch is over, and now maybe we are entering into wave 2, wherein mutual funds will there's a lot of redemptions or a lot of payback that NBFCs have to do to mutual funds, and therefore there could be liquidity issues which might hamper the returns from a mutual fund investor's perspective. What it does to NBFC stocks is one thing. Right. What it does to mutual fund holdings is the other thing. So do you think that a liquidity crunch in this round, if there is a liquidity crunch, and if that will impact mutual funds in the next couple of months?
Yeah, I think first and foremost, I would start by saying the liquidity fear that was there in the market starting from September, October, then going down to as late as Jan, February, I would say it's behind us.
Okay.
And the worry is behind us. And why I'm saying this is that the liquidity has to be seen in from 2-3 angles. One, what is the overnight liquidity that all as mutual funds and banks buying and borrowing and lending to RBI, and that's something is becoming a surplus, and the Reserve Bank of India has pumped in a lot of liquidity through sale of government securities and therefore injecting liquidities, buying of government securities and injecting liquidity in the system. Secondly, we've also seen a good amount of flows coming out of the equity market from foreign investors, as well as FDI investment coming from foreign investors, and both put together, Reserve Bank of India have been buying dollars and pumping in liquidity. And the third, which they have now done, is they call it as the voluntary retention schemes, especially for foreign investors who wants to bring in money to the country. So RBI is giving them assured cover for their forward cover. So through that route also we have got a lot of money. So therefore Reserve Bank of India has been ensuring that liquidity in the system is getting better through various monetary actions. And that's something has given a lot of comfort for borrowers. I think if you look at the market, the people who are, it's a good credit, and then there is an acceptance both from the point of view of rating, credit and the reputation. They have been getting money relatively at cheaper rate. It may not be cheap as what the Government of India gets it, but definitely it's better than what was prevailing in the month of say Jan, February. So there is good improvement. And second is since I think they talked about NBFC's things, crisis, I think the September, October, November, that same period, the exposures are very high. And the exposures into NBFCs were as high as about 4 lakh crore for the industry. And that has been gradually coming down. And then the money manager also, as the risk is being seen, so they also reduce the exposure to a certain sector which is considered to be the risky from the perception point of view, not in reality that they will default and so on and so forth, but at least perceptions if it changes. The money manager also accordingly change the portfolio construction and reduce the exposure to certain segment of the market, which normally they do. And that in my view, I think most of them have done it in the last 2-3 months. Therefore, any potential risk that could come in the next 3-4 months, but I don't think it will come on account of liquidity. I think it could potentially, if at all it comes, if there is a further downgrades, if something comes, then it could probably have some kind of impact in the near term. But I don't think it's an issue which I have been of the firm opinion that the credit market also, the calm is returning back. Basically, the kind of noise which was pretty high, that gradually is coming back. Most of the borrowers whose rating have been downgraded have been taking some kind of aggressive steps in downselling some of the assets and raising money and looking for foreign buyers, looking for PE investors, or looking for buyer for some of the assets. I think everybody actually the fundraising mode. And that, in my view, will provide necessary liquidity in the individual balance sheet. From the system point of view, liquidity is good. But individual point of view, any companies who have been struggling to raise liquidity, I think they, of course, on the edge, but they will continue to work that hard to ensure that they don't get into any kind of trouble.
Do they have enough assets, Bala, to be able to tide over? One, of course, they keep a lot of buffer. Any which ways, we've seen a lot of NBFCs do that. The growth capital is almost absent.
Correct.
It's more survival capital. But two, even that, I mean, if there are large repayments due, do the companies now have assets which others might be interested in buying, which will enable them to meet those repayment obligations?
Yeah, I think that's the way they will have to do, because
do they have those assets?
They have assets. See, most of the companies you take in the NBFC space or HFC space, they have an assets which can be assigned to somebody. So the question is how much they are able to assign and what is the kind of margin they have to keep aside for every 1 rupee of assigning, you need to probably keep 1.3 rupees of assets. I mean, the 0.3 gets blocked up just because you have to take that assigning a loan and then get the money from the bank. So therefore that 0.3 actually doesn't earn anything for you, but extra are given to the borrower, lender, sorry. At the same time, for any such kind of events, you need to also keep some kind of cash collateral.
Yes.
So to the extent your money, I think, gets blocked in the cash collateral. So therefore, while there will be some challenges, but I don't think it's something which is not possible for any of these people to manage. In order to, one, be in the business, second, ensure that they ensure they meet all the obligations. And another important point I think one has to understand in the NBFC space, if I have a book of, say, about, I'm just giving an example of 10,000 crores. The 10,000 crores is actually lent to somebody, and that somebody actually has borrowed 10,000 crores from me collectively. They are supposed to pay me an interest on aggregate of, say, 9%. That means the 900 crores of income is supposed to generate out of that, divided by 12 months. It's supposed to give me every month so much of money is supposed to give me cash flow. And second is when you all pay the EMI has got two components. One component is the interest component, second component is actually the principal component. The principal component is roughly about 2-3% also comes in. That way, if you look at this, have natural cash flow, which also comes. Only the question is the natural cash flow which they are getting in permanent basis, purely on the basis of the book of the size, need not be necessarily be sufficient to meet some of the obligations they may have, either on the prepayment of interest, on interest things, or the natural maturity that they may have.
Yeah,
which is where I think the gap could be there, which I think each one of them have to manage it. So my only opinion is each one of them have survived from September till April, May now. So almost about 7 months they have actually ensured that no default happens. And another 3-4 months, if they will pull along, which in my view they will be, I think things should come back to normal.
So before I ask the next question, there are some, through some reports, we've gotten this data, Bala, out of how the exposure to some of the most spoken about stressed assets are, right? So the Credit Suisse note, for example, speaks about how overall mutual funds have exposure in about 20,000 crores to DHFL, SL, ADAG and IL&FS, and the risky exposure the fixed maturity plans have to these companies total to about 2,200, and the AUM of schemes with the exposure is about 18,400. So in light of these numbers being circulating around, do you think the markets will take a benign view to debt plans? Because I hear a lot of people say this, that single A rated plans are right now giving yields which are substantially higher than what they have given, but the market is probably not going out and buying them. Is there good reason for this?
No, I think we have to look at it. I think the number what I put, 18,400 that I put, see the amount that is in dispute coming out of these 5-6 entities name that he took, the aggregate amount comes to about 8,500 crores, which is as per the CSB report.
Aggregate amount, yes.
Let us take that the number that one has to look at it. What is the ideal loss that one will incur on this? 20%, 30%, or 40%? I would assume roughly about say 20%, assuming you will take a loss. On 18,000 crores, the loss that you are talking about is only about 3,600 crores, right? So 2 18s are 3,600 crores. That much is the total loss. And we are talking about 3,600 crores of loss and a total size of the industries of about 1,50,000 crores in the credit and credit-related funds. That means it's only about a few basis points in the overall scheme of thinking. Therefore, while it being talked about something is very negative, but in total context, if you look at it in the total size of the industry, and then convert that into basis points from the return point of view, is hardly anything. See, that can be recovered over a period of 1.5 months' time. And incidentally, I was just looking at, again, I'm talking about the overall industry. It's about 14 lakh crore is the total industry size on debt. And total industry is 14 lakh crore. What you're talking about is only about 3,600 crores of total loss that can potentially come, if at all that comes. Though the probability in my view is very low for that. But still, if it comes, if at all it comes, only that much comes. Therefore, one should not unnecessarily blow up this current issue is being talked about as something, it's a hugely negative for mutual fund. That's one. Second is, while coming, incidentally, I was just looking at the fixed income schemes return. So we always look at the fixed income schemes return when there is a mark-to-market loss. Then we start assuming that scheme has given negative return. While it is true, there's absolutely no doubt on that. But the loss also, one should remember the fact that the loss also gets recovered as time progresses, because the fixed income schemes have got three components to it. One, a daily interest accrual, which comes in the form of a coupon that I'm accruing every day. And second is interest rate fluctuations arising on account of monetary policy action and the market movements. And third is coming on account of credit migration. Sometimes the credit upgrade happens where yields go down. If the credit downgrade happens, yields go up. And if the downgrade happens, naturally, of course, there is a mark-to-market impact that comes. In these three components, the single biggest component for generating income for the investors is actually the interest accrual. And that component is so large. Any loss that comes on account of interest rate fluctuation or maybe the credit migration or default is actually get adjusted against that. Therefore, ultimately, the investor's loss is not about the principal, it's about the loss in the income that he gets.
Sure.
So that's why I think one has to understand the fixed income space. Therefore, I am of the firm opinion, yes, the industry have gone through the tough time in the last 4 or 5 months, but it's not something which I think one should unduly worry about, that fixed income and FMPs and things. And second is, I think a lot of people talked about FMP. How many of the investors have put money actually in FMP? The FMP size is only about 2 lakh crores roughly for the industry. And the whole 15 lakh crore industry, only 2 lakh crores. And the FMP is not predominantly the retail investors who have been participating, the institutional investors who have been participating, and some bit of HNIs. And that again, industries, FMP investors are predominantly those investors who actually come with a specific period. And secondly, they also come, there is a lower expenses, and they don't take the mark-to-market risk, and they don't take the interest rate risk, and of course they do the credit risk. Therefore, they know very well clearly I'm taking the credit risk, but I'm coming for the comfort of staying with the fund for the last 3 years, for the next year, 3-year period, or 2-year period. Again, that segment in the overall scheme of thinking in the fixed income space is not very, very high. Maybe the one FMP is getting impacted, getting affected, where there would be only about 100 investors. That impact is only for that 100 investors who have put money in an FMP. Is not for the 5 lakh investors who have put money in fixed income schemes.
Yeah, I mean, I don't think everybody is saying that the entire space will get washed out, but there are certain pockets which could get hit more, and those investors could. And therefore, so that is one argument. But the second argument is this. On the contra side, wherein I hear a lot of advisors saying that go out and buy the A-rated debt instrument funds, because those are giving very good yields, and there is a little bit of risk, but the risk will not be so much that it will reduce your returns by so much that it matches the fixed deposit returns. So therefore, according to a couple of advisors, those plans are a good plan. Do you think
ultimately, yeah, I agree from where, I understand where from you are coming. It's more about asset allocations. When I look at the fixed income has got 2-3 different type of schemes. One, of course, is purely the liquid funds, which is it's just like lazy investing that you do, like savings account. Then you have a low duration kind of assets. Then you have a medium duration assets where you don't take interest rate credit risk, but you take interest rate risk. And finally, is the credit risk fund where you have an accrual. So when you look at the whole three different type of asset class, 4 different type of asset classes, that some portion of the assets of say 5 to 10% assets can go into this kind of funds, which are having high OITM. Those OITM has not come because companies are offering high coupon, but those instruments actually got been downgraded. Therefore, OITM has gone up. Therefore, that's something which I think one can take a risk to some extent of your portfolio. But having said that, these funds either will lose more money. If there is a real, in reality money doesn't come back. At the same time, when money comes back, whatever the provision that has been made, I think will return back. And that's something, the probability of the write-backs coming into these kind of schemes. Because when we make a provision, unlike a bank, whereas when you make a provision in the mutual fund, any downgrades of D, we straight away mark it down the value of the portfolio for 100 rupees value, we bring it down to 75.
Okay.
And we bring it down to 50 rupees. Are we going to realize only 75? No. Are we going to realize only 50? No. Maybe we'll get actually 100% of our money, but we are giving a time for the company to give back the money. So therefore, the write backs could also become easily, I mean, it could be quite possible. Therefore, from investor's point of view, he has to allocate some money in that. He can allocate some money. Some of the advice what they are doing is right. But as long as you don't bring in the greed element, and then go and say, so much of write back going to come, therefore I'll put 100% of my money, if that's why I think you'll have your problem.
Okay. Let's shift focus to equities. It's not just about these funds, right? Now, over the next 5 years, with an assumption that we're talking about the next 5 years of this current government, what do you think will do better? Large cap funds, multi-cap funds, because they have both large and mid and small, or would you believe that small caps and mid caps will play catch up and therefore small and mid cap funds could give a higher beta? I know all could do well, but what's your gut about what will do the best?
See, we'll just interestingly see a chart. The large cap versus mid cap and mid cap versus small cap. And then we looked at which is the index today is at all-time high. Where Sensex is an all-time high, your Nifty is an all-time high, your mid cap and small and mid cap, they are trading at 18% discount to the all-time high. Which naturally means, of course, if these companies have to come back, then it's perform. Because we are talking about 5 years of visibility for India as an economy, both on politics as well as on economic growth. Maybe it can even extend to a decade or so. I would even take a bet. Maybe you are looking at for a next 1 year of 10 years of bull market, bull economy, I would say. So bull economy on multiple areas. So with that, that's what I think one has to put a belief. When you give such a long time for one to perform, then naturally this underperformance has to catch up.
Okay.
And second, I would also assume that large pool of companies coming in the mid and small cap space, we'll see actually earnings improvement coming in, both on the business outlook improving, and second is on the interest cost coming down, also would boost the bottom line. Therefore, earnings uptake I think will come largely from the mid and small cap companies as you move forward faster than the large cap companies. If somebody taking a 5 or 10 year period, then definitely I think one can take a bet on investing in multi-cap and mid-cap and small-cap funds.
Over large-cap funds. Okay, that data that we have is also pretty interesting because it shows the mutual fund returns. And yeah, if I can just get that chart very quickly before we get the next thing. These are the returns. So 1 year and 3 years, you can comfortably see that the large-cap category is beaten mid-caps and small-caps, especially the last 1 year. But look at the longer duration and look at how handsomely the mid-caps and small-caps are beaten. Now, past performance is not an indicator of future returns, but Bala believes that maybe there is merit in looking at the earnings growth that would come in select mid-cap and small-cap firms, and therefore maybe these funds could do well. I believe that's the assessment.
Exactly. The chart, I didn't see the chart earlier, but I think the chart shows on its own.
Yeah, it does show. And let's see if the past performance actually gets replicated in the future or not. Bala believes that maybe there might be merit in trying to play that bet. What's the strategy that you would suggest to investors after elections, Bala? Mutual fund investors or plain investors, and predominantly mutual fund investors though. And are there a list of do's or don'ts that people should keep in mind?
See, first and foremost, I think one should not try and time the market. There's absolutely no doubt the bullishness is coming, returning, and India story I think will come back. Foreign investors is probably this time pumping more money into India compared to the last 2-3 years. And because at the end of the day, they also need to have better alternate to their own investment strategy. Investing in global market. Therefore, India would figure prominently in their investing concept. And that's being the case when somebody is trying to time the market and therefore I'll wait for market to come down. In my view, that one should not make the mistake. And at the same time, I think what Indian investors have started doing quite rightly, thanks to, of course, industry players propagating the SIP way of investing. And SIP is actually the way of investing is becoming a habit for investors. Therefore, that one should not move away from that and continue to do and put all the money in the form of an SIP or short-term SIP or long-term SIP, whichever way you want to do it, and then start that investment continuously. Don't stop their investment. I think what one should not do, most of the people, 1 year return doesn't come on SIP, they get suddenly worried as if the money is invested only for 1 year. And we should look at, I think, beyond, I think you are investing for 10 years. Therefore, don't make any investment decision on the basis of last 1 year, how the investments have performed. Therefore, on the basis of you base your future investment strategy. It never works like that. I think they need to actually have the conviction, continue to be refocused on SIPs investing, and continue that. Whether it is lump sum investment, whether it is SIP, or invest in fixed income scheme and through an STP and so on and so forth, and that's something the strategy one should continue. And again, they should continue to focus on asset allocations. Because today one asset class will do very well, tomorrow will not do well. There is no absolute guarantee that one asset class will continue to do well ever in this lifetime. They will go through some ups and downs. Therefore, the asset allocations between fixed income and equity, to some extent even gold. I think if we keep that as an overall principle and high focus on asset allocation, I'm sure investors will make money out of mutual funds.
You do that too?
I do that too.
Okay.
I do that too, but although I am overweight on equity, in the last 1 year the portfolio didn't do that well. it's fine. But anyway, you are investing for long term.
Okay, that's, well, a candid disclosure too. So do you see, I heard you mention that there is a chance of a bullish economy stroke market cycle, but do you believe that in this bullish market cycle that you envisage, the returns that the Sensex, for example, or the Nifty could give would be better than the CAGR number for the last 5 years? I think that number is somewhere to the tune of 11 to 12%. Do you think the next 5 years the Sensex CAGR returns and thereby any of the index funds CAGR returns would be higher than that? Is that a possibility?
So I think higher would come as you go down the ladder. I think if you look at the Sensex and the Nifty, these are big companies. Big companies beyond a point is unfair to expect them to grow beyond the nominal GDP growth. So if they expect that they give earnings growth of about 11-12% or maybe 13-14%, it's unfair to expect these companies that will deliver return to the shareholders beyond this return what you are saying.
So the return expectation,
as you go down the later,
sorry, no, so the return expectation, because we got this graph made for you, the return expectation according to you that anybody should keep in mind is the nominal GDP growth plus some premium.
1 or 2%. That's it.
Okay, that's it. People should keep that in mind when they're investing in large cap funds.
Correct.
Okay.
And second is another principle is as you go down the ladder, as they move from large cap to the middle and small cap, that naturally the earnings growth will be much higher than the larger companies. Therefore, one can expect a little more than what the large cap companies deliver, a Sensex or Nifty delivers. That one expectation one can have, which will be another 1 or 2% one can expect that. Having said that, one must remember that while we talk about India is a fast growing country and we have the highest GDP growth, everything compared to the global economies in the world is fine. But what is the number you are talking about? I think if you are able to sustain about 7 to 7.5% GDP growth, aiming for 9, 10 is I think too optimistic. And I think we as an economy will be able to sustain 7.5% growth. I think 7.5% growth with no damage, scam or no any kind of ups and downs. I think we will be able to sustain that return expectations over a period of time. Having done that, I think India also has focused very clearly on keeping the inflation down. That means we are talking about 7.5% GDP growth. Inflation average about 3.5 to 4%. The return comes to about 11%. The earnings growth about 2-3% if you have to take more. Only that much is the expectation of return that you can have. Also remember, I think this is not factoring in any kind of potential risk that could come on the way. Along the way, we will see some kind of restriction, risk that could come. If we capture that, then we may see some kind of fluctuations, but on an average, one should not expect beyond this.
Okay. Bala, the famous last words, if I can call it that, but any other piece of advice for investors? Stay the course, asset allocation, all of that is fine. Anything that they should keep in mind as they look to invest at these levels for the next 5 years?
I think clearly I just repeat that keep a high focus on asset allocations, and there is no one asset class that you should just restrict to. I think each of the money has to actually revolve around 3-4 asset classes, which includes fixed income and equity. And finally, I think the discipline ultimately will make the investors more successful. It's not about listening to the day-to-day noises and the basis of which you form an opinion. Because when we have seen in the last 25 years, we do see accidents, and these accidents actually gets healed over a period of 6 months to 8 months period. Therefore, every investor has to give that time and have a tolerance to go through their volatility and not change the course along these kind of events in their portfolio, and that will actually create more damage for them. And final last message is a lot of people actually have been not redeeming and then stopping the SIPs. They must not do that. I think the worst thing that they will do in their allocation of portfolio, having started an SIP, they should continue the SIP rather than just stopping in between. The moment they do that, they will never get that benefit for which they are making the investment. So
the number of SIP inflows or the money that is coming through SIPs even in the last declared numbers has gone up. So is it that while there are new investors coming in, a lot of existing ones are stopping their SIPs? Is that the reason?
Some of the existing investors, I've been seeing actually the last 3 months for the trend for the whole industry. Earlier I used to count I used to count a number of close to about per month, close to about 18 lakh new investors used to come. And the redemptions, subscription stopping would be used to be about 2 lakh number.
Okay.
And today that 18 lakh number has come down, but the 2 lakh numbers have gone up.
Oh, okay.
So basically the cancellation also has gone up. That essentially means some of the existing investors who came with a lot of hope and expectations that I'll invest in mutual funds in the SIP route, but suddenly I see some of them actually stopping it. They should never make these mistakes.
Okay.
Yeah.
Important advice, stay the course. I think that's something that almost everybody who's on the show every single time mentions. But Bala, it's a special day for us, so thank you so much for joining us on the second anniversary of the Mutual Fund Show. Really appreciate your time. And thank you for your advice.
My pleasure. Thank you.
All right, viewers, and thanks for tuning in to the Mutual Fund Show. Stay tuned to Bloomberg Quint Live.